Hello there, traders. Welcome back to the TOGS Trading Podcast. We're up to episode 20 now of this first season of the TOGS Trading Podcast. And thank you all for those of you who have subscribed, who've liked, who've dropped us comments. It's all great. We really appreciate it. Okay, we try and take it on board, as and when we can. So we are very many thanks for that. Okay, so TOGS 20, what we're talking about today, we're going to talk about indicators. Indicators, are they actually any use to us whatsoever as traders? So, as always, I'm joined here by Big Ian. He's on his return from his trip to Germany. So, looking good, Billy Ray. How are you doing?
Thank you very much. I think I've camouflaged myself between white hair, white beard, and a white background.
That is right. You're kind of a whitish.
If I stayed still, if I stayed still for a little bit of time, basically.
That's right. We can only see you when you blink.
I'll wave. I put on my glasses, right? They got black rim.
Oh, there you go.
Everybody can
There
see
you go.
that.
How are you doing?
Oh, all right. As I was just telling you before that, I split a bottle of rosé with my wife last night, and I woke up this morning feeling horrid, which is kind of probably my age now.
Well, as we said, I have no sympathy for you. All right, if you're going to drink rosé and stuff, you and I, we are aligned on many things, but wine drinking, your love of rosé and German Riesling is an area where we diverge quite dramatically.
I suppose, yeah, because I think rosé is probably one of my favorite things of the summer. To be quite honest with you, I really enjoy it, and I actually think it's really quite good value. It's one of the very few wines that you can get that's okay quality. It does exactly what it says in the tin to a certain extent, and you don't pay a huge amount of money for it. So I really quite enjoy that aspect as well. If you're having a dinner party and you have to go out and get half a dozen bottles or something, it's actually like a really good option, and it goes with a lot of stuff. Sort of lighter meat dishes, and I would happily put a tabal, a darker Riesling, darker rosé with steak. Myself.
A dark rosy mistake. There's controversial opinion for the TOGS Trading Podcast
terrible,
there, isn't it?
Yeah, but then I would put red wine with fish too occasionally. But it's the tannins in the wine. Yeah, it's the tannins in the wine that's the real problem with fish. It's not so much because when you're matching wine and food, it's the weight of the food really that matters. And then after that, for me, it's acidity, and then it's tannins. And so if you have a heavy type of fish, like a heavy meat fish, basically you can put something like a Beaujolais or I can't think of the name of it. Actually, it's gone out of my head. Bernard Baudry makes it. Anyway, Cabernet Franc or something. I think it is I think it's what I'm thinking. Right. Yeah.
Well, you see, I trust your judgment on wine and stuff. I would, I know your background and stuff. I know, you always choose a good one.
Yeah.
But nonetheless, white wine and rosé. I mean, I can understand the trader in you, getting pleasure from buying under value, being able to spot value in the market, all right, and get decent price, get decent price product and stuff and what have you. That's I can see that, but it's not for me and stuff and what have you. So, and I certainly, well, in fact, you're talking about wine rosé. I was at a music festival at the weekend. Glaston Budget, which is for those who don't know, is kind of a version of Glastonbury, but it's all using tribute bands from the 70s, 80s, 90s, etc. and stuff. And it was very enjoyable. But my partner and my mate's Dutch fiance were trying to basically trying to squeeze into the festival with bags of white wine taped to them, and not only was that a kind of a foolish endeavor, but the wines they chose were pretty. Pretty. They didn't even like them. They didn't even like why you're trying to sneak in white wines that you don't even really particularly like and stuff. But and as I was saying, the upsetting thing of the day was that they had a Prodigy tribute band start off the festival on Friday evening. I love a bit of Prodigy. I'm a '90s boy and all that and stuff and what have you. And they were very good. I was really enjoying them. I was sort of reliving my '90s. until the two young girls sort of kind of stood next to me in the crowd. Sort of were I overheard them saying that this is the Prodigy. This is who my granddad listens to. The Prodigy is now music for granddads. What has happened to us? What has happened to us? There
I
we
know
go.
it's a terrible thing because I went to Glastonbury 31 years ago.
Jeez.
So that seems like a scary number to say in itself. That's an entire lifetime for a lot of people.
Yeah, I know.
So
I know.
yeah. So I suppose yes, the old
Depressing.
aging process is terrible, but I still don't see it in myself. Not at all.
Well, no, of
The
course
only
not.
person who
Of
ever
course not.
reminds me was my doctor. He just gives you the waggy finger
Right.
once in a while and goes, "Your lifestyle, you should really exercise more and eat more salads or something."
Yeah. Yeah, good advice. Good advice. But anyway, onto more trading and trading endeavors. So as you said today, we're going to talk about indicators. So what are your thoughts on them, Ian? Do you rate them? What, if any, indicators do you use yourself?
Oh, I'll get on to which ones I use myself in a few moments, but I mean indicators are a handy thing. And I think that every trader goes through an indicator trading phase, like especially day traders. Anybody who gets into day trading, what ends up happening with them is that they tend to get fascinated with with what I would use as a trigger chart, so a low time frame chart, and then they start trying to build a soup of indicators that's going to spit out a signal which is going to work at least 70% of the time with a decent RR. The problem that I have with that is the fact that it doesn't work for a start, and that if there really was a standalone edge in doing something like that, there are rooms of PhDs working for hedge funds who are going to come across that, who are searching for that. And if they do search for that and if they do find the same edge, it'll be gone in a week because they'll algo it and off they go. So it's just part of the Grail search, that people see with the it's part of the Grail search that people go through, I think, with learning to trade, like basically, and it's and a lot of the time, one of the biggest sins I see with a lot of newer traders as well when they're going through that is that when you look at the indicators on there, you've obviously would have got people would send you screenshots and there's like 3 different oscillators on it, and they're basically putting on indicators, but they're putting on indicators that draw from the same root source. So you have 3 oscillators effectively on your screen. They'll never work at exactly the same speed. You're never going to get a stochastic and RSI basically working at the same speed. So one is always going to contradict the other. So who's the winner at the end of the day? So that doesn't work. So what I'd rather do, if you are going to use a lot of indicators, is try and use indicators that give you information about different things. So, and use one primary indicator. So I use one primary indicator. I use a standard 1433 stochastic. And I use that for everything. That's my main indicator. So basically I use it most on lower time frames on my trigger chart. So I want to buy with the stochastic over supporting the trade. So if I want to sell, it's overbought. If I want to buy, it's oversold. And that really helps them basically get into the trade, because I suspect, as well as a lot of other traders using indicators like that, I think an awful lot of the algorithms tend to have some sort of inclusion of those types of indicators, and it just helps. It doesn't have an edge. Stochastic doesn't have an edge on its own, but it does have a help. Basically, it does help you into a trade because every indicator, it only happens in a certain context, and that's the other thing that they have a problem that I have a problem with, is that traders, they think that their indicator system is going to throw out a signal, but it's all contextual, because indicators don't work in every market. Like, a stochastic in a choppy market is just going to get you chopped up. That's all it's going to do. And I think it's unfair to look at indicators and expect them to be signal devices, because the hint is in the name. It's an indicator. It indicates that there's a probability of something happening if the context is right.
Totally.
Yeah, and that's the thing with them, I think. Um, yeah, so that's
Yeah, I think that you make a good point there and stuff. Might it is part of it's almost like a phase that traders will go through, thinking that indicators are the best thing since sliced bread, and that they are the answer to all of their problems, and that it's part of that holy grail that they end up chasing themselves. And actually, it can be a bit of a dead end if it is approached incorrectly. Right, and very often it is approached incorrectly because these people, they're new to trading, so they don't really understand context. Okay, they don't really fully understand. What they're doing is they're just looking for victory. They're just looking for winning trades. And as I said in the past, I've coached people, I educate people. People have sent me screenshots of their charts. And there's like 30 different indicators on there. There's like 20 different moving averages and a Bollinger Band and a Keltner channel and a PSAR, and then there's CCI and RSI and MACD and a whole host of other stuff that's on there in one form of oscillator or another. Okay, and what's happened really here is people have used these indicators it's almost like a security blanket, almost like a comfort blanket. They think that the more indicators they have on the chart, the more that when these all line up, it has to be a dead cert victory. They're trying to avoid the pain of loss. Okay, avoid the emotional pain, avoid the financial pain. They hope that by when all these things align, that they're going to basically it's a dead cert trade. But the thing is, you've got 20 odd different indicators on your chart. Might only align once or twice a year, and even then, that could still fail because there could be all sorts of other contextual elements that are in place and stuff. So, my view would be that they do have a place and they can be used. Okay, they can be used correctly, but only minimally and as part of a decision making framework for, I'd say, for newer traders, in terms of if it helps you, build a case to take a position, then that's absolutely fine. But it should be just part of a decision making framework. It's not. This is not some all killing laser death ray that is just going to effectively make you invincible when you enter and engage in markets, right? Because it's if you think that, well, then you're just deluding yourself, really, aren't you? That's not it's not necessarily the smartest way to operate and stuff. And I very often, a lot of people will completely poo-poo indicators. As I said, I think they can have a place and they can be used, and maybe we'll talk a bit more about them later on. Very often, when you see, quite often, sometimes you'll see people that have done, MSc students, etc. They're doing their dissertation on why technical analysis doesn't work. And they're not traders themselves, but they've run some tests on MACD crossovers, all right, and found that they didn't work, and then they used that to sort of announce that all technical analysis is dead, is useless, after this 2 years of doing their dissertation. Whereas if they'd have just called me or any other trader worth their salt and said, listen, do MACD crossovers work? I'd have told them, no, not really. There you go. I've just saved you 2 years of work and a 10,000 word dissertation. Any trader worth his salt knows that it's not that. But it can be part of a decision-making framework within the correct context. And it's getting that context right in that decision-making framework right. But that's actually more important. But maybe that'll come to maybe we'll come to that in a different session.
Yeah, because I think sometimes, because it's very tempting, I think, because it would be lovely to have this indicator suit that just turns out a signal every so often, and you press a button and you have a 70% chance of winning. That it's a really tempting thing to want to have. Like, I'd love to have that, but it's also, as well, I think it's because when people come to trading and they look at the skill of trading, like they want to learn the profession of trading, what they tend to do is approach it like if they were learning plumbing. Plumbing has a kind of a yes and no answer. This thing fits here or it doesn't fit there, and you can learn it step by step. Where trading can be much more intuitive. It's about taking in a whole universe of different things happening and then processing that and reacting to it in the appropriate way. And so it's that's probably the biggest difference between how newer traders see trading, where they see it as that this easy learnable skill. If I can find the right indicators and I can match it all up in the right way, I can win. Versus I have to change myself and become a completely different person. One of the other problems as well when they're back testing, because I mean I came across it as well in my own times, when you're back testing indicators, you get an awful lot of false signals, because if you do, we say like crossovers, any kind of crossover, a MACD crossover, EMA crossovers, anything like that, what you will see is you will see the crossover happen and then cross back and then close without ever having crossed. It will have given you almost a valid signal and then taken away the valid signal, but you're stuck in the trade. So when you go back and you look at them and you back test them and you count how many worked and all that kind of stuff under what circumstances, you come out with a false idea of how good that they actually are. And also it depends then on how you, and then the problem is as well is that once you know that, you start getting scared when you're in the trades. So you see the signal and you might not necessarily take the signal because you're not sure that signal is actually real. And that's one of the problems I think with them. I think everybody should know a good few indicators because they're used. Algos, I'm sure, are plugged into them. Other traders are using them. They are a help. And one of the big things I find with indicators is that they're not signal devices. You can learn to read something like Bollinger Bands, and you can learn to read the stochastic, for instance. Like I read my stochastic. So I'm not just interested in it being at the highs or the overboughts or oversolds. It's how it's reacting with price. So to give you an example, if you want to confirm that you're in a downtrend, you'll see if it goes from the oversold to the overbought on a quick chart, on a 699 tick chart, for example, or a 1 minute chart, the speed at which it will go from, or the distance, sorry, price will go for, or say the stochastic will go from the oversold to the overbought, but price won't move that much. And then when it goes from the overbought to the oversold, it'll actually move quite a bit. And you'll see that happen a couple of times. And now you're in a particular type of trend. If you see the stochastic cycling, when price isn't moving, there is a high probability that your move is in trouble because the stochastic is going to cycle, but somebody is somebody is stopping price actually moving. Like somebody has made the decision not to move price. So I find that quite a thing. And you can read things as well. I mean, this is strictly an indicator. You can read volume. Volume is a great thing to read, especially on a 5 minute chart. Like you can sit there and read volume all you want because because you can see that there are areas that price has to do a certain thing, and then that volume either has to come into the trade or else the trade's going to fail. And just as with the reading thing, like I mean, 20% of my job is probably just reading stochastic on a quick time frame. And I know other swing traders who have made their living out of just simply reading the Bollinger Bands, because the Bollingers, for instance, will start to straighten up before they move up. And then they kind of look at that and they're looking at basically as the bottom of the Bollinger Band being support. And as it straightens up, they're buying double bottoms off that.
And
that's just the thing they do, basically.
I think that leads into a conversation about people interpreting the data that comes out of the indicator. We know all indicators are lagging because the OHLC data that everybody else is getting is being displayed in price first, and then it's being constructed into the indicator. So it's always lagging, it's always behind. But if you work with an indicator long enough, you will start, as you say, to get an understanding of it. So I use a version of stochastic on the weekly chart, but not for overbought or oversold reasons, more as just an indication of where there might well be momentum, so that if it's showing me that meant, if I'm a momentum trader and that momentum is no longer there, then why am I? And also just giving an understanding of the kind of using it as almost like a an insight into the underlying current. Okay, the kind of the longer term current rather than just a few of the, let's say, the waves on the surface. So that is my interpreting. That's me using an element and then interpreting it my own way to help me make a decision. I don't. It's not. I don't have buy or sell signals off it. It is helping me to understand the environment, to understand the context, and then from that, make my decisions elsewhere and stuff. But that can come from thing, and lots of people will use Bollinger the Bollinger Bands as an indicator of volatility. As you said there yourself, they tend to go flat, they go straight when basically there's a compression of volatility, and invariably if they're expanding, that in themselves is telling you something, that there is an expansion, okay, that there is a volatility returning to that market. Kind of one final point, just this is for myself, is that I don't really use volume, and that's not to say it doesn't have use. It can be enormously useful, but my background is FX. All right, FX being it's not, doesn't go through a central exchange. And so it's an OTC product. Okay, so the volume was never really there, and if the volume was there, it was never really there to be trusted, because you didn't know where that volume was coming from or what it was truly reflecting. So you just basically get used to trading without indication of volume. That's fine. I can still make my decision. I'm quite happy to make decisions on price action and one or two other elements and stuff. I can completely understand if you are a stock trader, or if you're an index trader and stuff, that actually volume can be unbelievably helpful, and utilizing reading that can be immensely helpful and stuff. Is, once again, it's about horses for courses, as my old maths teacher would say, and understand the context and the environment that you're operating in. That becomes unbelievably important, doesn't it?
One of my indicators, let's talk about volume. One of the indicators I have on my screen, I have a suite of indicators I bought from, I bought from a crowd called E-Mini Watch. Better indicators, they're called, and basically one of them it tracks changes in trade size. So basically, if you're coming to a bottom, or you're coming to a top of a move, basically, and you start seeing, and the trade size starts changing, so basically it's professional money effectively coming into the market. It's useful, but again, I give up all my other indicators except my stochastic. If I had to.
That's interesting. That in itself is telling you something, isn't it?
Yeah. Because it's far easier to read a stochastic where and even to read just raw volume is not, it's not the hardest thing in the world to read raw volume when it's coming in through, because the thing is that you just have to know where price is. That's a big thing with it. The other thing I was going to say is that contextually, like an oversold in a support area where you're expecting a trend change is a completely different thing to the same signal 50 points above a turn area. 50 points above a turn area, it might generate a small little start of a move, which is actually going to help you get into the downward push. And that's the main use for them. But it's the context is so important. And lagging was one of the things when I was reading about these, or when I do hear about indicators, is that everybody's complaining that they're all lagging, but everything is lagging. Bloody candlesticks are lagging. If you want to look at it, that you're reading the past. So, and people who complain about lagging, I don't know where are they trading in some market where there's nothing but V bottoms? Yeah, at the end of the day, because that's the only time that it really makes that much of a difference. Because is it with the V bottom, and you don't get a lot of stuff with a V bottom, but you're either trading something with high volatility or you're trading a low time frame chart. Because I went this morning and looked back over the ES on a 5-minute chart and looked at the stochastic, and the stochastic could be oversold for an hour. And in my context of the thing, an hour is nearly a quarter of my workday. So the fact that they're lagging doesn't really make any odds to me. Like, basically, it doesn't really affect it because they're giving their signal in a timely enough fashion, and it's fear, I think, that traders have, that they're going to miss out on something, that if they don't get that very first bar of a move, that they're going to something's going to go wrong for them. And their real work is to get all the safe money, not all of the money in a move. So you want to have some sort of confirmation. So you might have a signal, then you want to see price break a trend line, and then establish above the trend line, because that's one of the things I think as well that traders don't understand is you have a trend line and you can have price pierce that trend line, but that's not a break of that trend line. It's not a break until price establishes on the other side.
Yep.
Basically, because excuse me, because price is going to test trend lines and things like that all the time. So lagging for me is probably one of the most overused rubbish problems that people come up with when they're talking about stochastics. Talking about indicators, that all the indicators are lagging, because there is nothing in the market that you have. Technical analysis is all about making a prediction about the future based on the past. An indicator is making a prediction on the future based on the past.
Yeah, I think my view on that would be is you're right. Everything gets called lagging because it generally is, and so if you're looking for a way to use a lagging indicator to give you a leading indicator of the next possible move, it is when you start using indicators to identify divergence. Okay, when there is a divergence between what the price is doing and what the indicator is doing, that is a very, very useful tool. But so, for example, if you're very new to trading, if price makes a new high, but the indicator doesn't make a new high, the indicator makes a lower high, that's an indication that that high is probably not going to that kind of move is probably not going to have the momentum behind it. It'll probably fail, roll over, be a false breakout, and that, for experienced traders, that is an opportunity to basically to let's say fade that breakout, etc. But even that, it is a very, very useful tool, divergence, but even that only works 50% of the time. All right, divergence only works 50% of the time. It's once again, you have to have a context within which to utilize it, to understand it. And as I said, just trading divergence off itself, if you just see divergence, it's 50-50. It is when you actually have the context of, and traders will know I bang on about this all the time. All right, it's all about having a confluence of events. All right, 2, 3, 4 things coming together at one time and place, at which indicator divergence might be one thing when it's happened at a level of resistance and there is a price action giving you a reversal pattern. Well, then that is a good use of divergence as an indicator, as a leading indicator. But as I said, I wouldn't just use it just because it's there. It ultimately always comes down to understanding the context, doesn't it? Whatever indicator you use, whether you want to use something MACD for divergence or you want to use stochastic or CCI or RSI, it has to be part of understanding the greater context. That's the kind of key I would drive traders towards, right? These, as I said, it's not an all killing laser death ray. It should just be part of your decision-making framework that allows you to make a very simple decision. Am I going to be a buyer? Am I going to be a seller? Or am I going to sit in my hands? It's trading isn't always simple, all right, but there is no need to overcomplicate it. Less is more. Generally, I just do believe that less is more when it comes to making trading decisions.
Weirdly enough, I don't use divergence at all. No, because it doesn't add anything into my system for myself. Like for the way that I trade, I don't find divergences make a huge difference. And I even have one of these indicators that just pops up the divergence as a little red dot.
Really?
Yeah, and that doesn't. It's actually a relatively good indicator in that it does its job, but I just don't bother with it because
I think divergence and scalping is going to be is challenging, but on the kind of, let's say, as you move up the time frames, it can help give you an insight that actually there is a very good chance that there will be either it is a false breakout or there is a reversal in play when you're sort of trading at this. Well, I've not really looked at divergence on those kind of really fixed time frames or tick charts, but I would suspect, just based on experience, that basically it's not. It's no better than anything else.
No, I'm not knocking divergence. It's just that in the way that I think, in the way that I do my own trading system, it just doesn't have a place, because it's about what has to hold and what has to break in my system, in my way of trading. So I'm looking at an area and I think an area has to hold. and this is where my indicator comes into being really useful. So I'm looking at an oversold in support, and I know this area has to hold, and that gives me help to sharpen up my entry. Because theoretically, I could actually get away without any indicators by just buying the area and hoping that price will protect the area, but the indicator helps me sharpen up the price. The last thing I was going to say about lagging is I think it just comes across as being the smart thing to say. For a lot of when I started reading a few of these articles for this thing, is that lagging seemed to be the smart boy answer to, oh, I don't use that, it's lagging. And there seems to be some almost masculinity thing about not using indicators. When I was looking at some of the YouTube things, we had all these guys going, oh no, I'm pure price action. I wouldn't dirty my screen with an indicator. And it doesn't matter. It only matters whether you make profit or you make a loss.
Yeah.
So, you can be all price action all day long and have absolutely no indicators, and that's fine if it works for you. But, it doesn't. I think that sometimes I think price action traders think they're better than the rest of us.
Yeah. No, I wouldn't necessarily disagree with you that. I will, there is, it's kind of, I think as we talked about it the other day and stuff about, kind of a weird masculinity into passing your prop firm within the first 24 hours and stuff like that. It's one of these kind of, what's the right word to describe it? False nonsense, basically, that actually holds no benefit. It is about the same with the indicators. It is about finding what works for you. What I would say, and I've said to many traders in the past, is if you're struggling to execute your plan, if you're struggling to make decisions, if you're struggling to make sense, then actually your natural inclination is to add more indicators to your charts because you think, oh, I need more indicators. Well, I need more indicators. Actually, what I would suggest, is to do the opposite. If you've got 4 or 5 indicators on you struggling, take one of them off and see how you get on. If you're still struggling, take another off. I do genuinely believe that less is more. Human beings generally will we will be able to take on board somewhere between about 5 to 9 bits of data, in a second, in a moment. So, let's call that 7. If you've got price and 4 or 5 moving averages and a Bollinger Band and an RSI and a CCI and a MACD and a stochastic on there, it's probably too much. And actually, you only need a couple of things on your chart just to help you make that decision. All right. As I said, lots of people add more because they treat it like a security blanket. Like, the more indicators I have, the safer I am. Whereas in fact, actually, that's not necessarily the case. All right, you only need 1 or 2, and that's plenty. All right, that's absolutely plenty for you to make a trade plan out that you're actually in a position to execute with flawless execution on a day-by-day basis.
Yeah. Well, the thing I think with the whole masculinity thing and all that kind of stuff is what ends up happening is that you let your ego run the show. Because if you're sitting there going, I'm not going to use an indicator because I'm a price action trader and I'm better than everybody else, then all you're doing is using ego. And this isn't an ego-based business. The only thing that matters in this is price. Is profit. So that's the big thing. I think one indicator you have to, if you're using indicators, one indicator has to rule. Like there has to be the one that you're using the most often, which for me is the stochastic. That's the one that I have to. That's the one that kind of will overrule the other ones. So if the other ones are telling me something, are telling me one thing, the stochastic is telling me the other thing, I'll listen to the stochastic more than listen to the other ones. And I have things on my screen, like I have PSAR on my trigger chart, for instance, because sometimes I don't use it all the time. Because sometimes when I'm a little bit unsure about a move, I'm sitting there and I'm thinking, well, this is a good technical trade, but I don't have the same belief in it, because I think that's 2 parts of every trade is technicals and then your belief in it. I let it turn the PSAR dot, let it change color, because a lot of the times once you get 1 PSAR dot, you get 20 PSAR dots or 10 PSAR dots. So the probability again has got a little bit higher. You've given up a little bit of the move to get that little bit more security. And that's another thing that I think a lot of amateur traders don't realize. They think that getting in a little bit later into a trade is missing out. You're leaving money behind you. But in reality, what you're doing is you're buying insurance. You're buying a higher probability because because the worst thing you can do is preempt trades, because then you're just guessing, and then you can't outguess the market for forever. Like, because one of the problems I had to overcome over my time was, like, I have a very strict trigger for getting into a trade. Stochastic has to support a trend line. It has to establish over the trend line. Simple as that. So it goes over the trend line. I can count to a little bit, get 2 bars, we say, on a very quick time frame. And what I started doing for a while is I would preempt that simple signal, thinking, oh, this area has to hold, I'm going to preempt it. And it took me a while to learn that I wasn't preempting anything. I was just guessing, because I was losing some of the time, because it would come up to the trend line, and trend lines are fantastic, because price will if they want to keep price going in a certain direction, they're more than likely going to keep it the side of the trend line that they want, and you might get a little push through. You might even get a bar the other side, but generally, which is actually rare enough, but generally because they don't want people to get out of the trade. If they're in a short, the smart money is in first, and they want it to go to a certain place. So it is their job to protect price on the way down. And one of the ways they can do that and signal to people like me who are in the market is to keep it under a trend line, because that's signaling the whole market that this move is still valid. It's still going to where we think it's going to go. And, there are forces, of course, that want to screw you over, want to screw you out of the trade. But in general, most of the time, my own experience, they want to keep you in the trade, and that means keeping price the right side of a trend line on the way down, so our way up or way down. So I find them very, 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 very handy. And the last thing I was going to say about that one, I was thinking about lagging as well, which I meant to say was that, because charts, every bar is a lagging bar, and you're looking at chart patterns, and you're looking at we say a head and shoulders with a wide-ranging bar, or just a wide-ranging bar. Wide-ranging bars are a great signal in the market, I think, anyway, myself. And that's a lagging thing. That happened in the past. And that's the same thing as if you're looking at a head and shoulders, like the head and shoulders was created in the past. So it's all lagging. Everything is lagging. So, and it's just that humans are creatures of habit, so we tend to do the same thing. So we see the same, same double bottom thing, and do the same things we did the time before, basically.
Yeah. No, I'd agree with you. I'd agree with you there and stuff. So, if we draw ourselves to a close, then it would be saying that, despite everybody, kind of the rest of the world saying that indicators are a terrible affliction, we both agree that actually they can have benefit. They can be enormously useful, all right, so long as they are aiding you in your decision making framework, and you're not using them as a sort of, I don't know, emotional crutch already, that they think that the indicator is going to bail you out, because that's never going to be the case. But it is about recognizing that it is just those indicators. It's part of a bigger decision-making framework, which allows you to understand the context. Everything is about understanding context, and it's kind of like everything with technical analysis, that everything works and nothing works. It is all about understanding the underlying context, the underlying environment that we find ourselves in, and that takes a little bit of time and experience to understand and know. But and as I said a bit earlier, my view would be, if you're struggling with indicators, you don't need to add more. Actually, take away. All right. Actually, I think cleaner charts, are better than ones with 20 different indicators on. Right, but you can still, with price and 1 or 2 indicators, that's enough. All right, you're fine. You can make your decisions. You don't need more. You don't need that. You don't need that overkill. Anything else you'd add to that, Ian?
No, just out of fun this morning, I put on every indicator on a chart that I'd ever used, just when I was writing the notes out for these, just to see what I'd used before in the past. And God, it was a mess.
Yeah, that's it.
Spaghetti
That's it.
junction.
Less is more. Less is more. All right.
Mm,
Less is more. So, there's it's it's a kind of that Goldilocks, that
mm,
Goldilocks window. Okay, you don't want nothing, but equally you don't want too much. All right. It's
yeah.
just a couple just to help you, and that is enough. All right.
Oh, yeah.
Keep it simple. Keep
I
it
think the
simple.
last thing I'd say about them is that every indicator you put on your screen has to give you something.
Yeah. Yeah.
There
You have to
has to
know
be
why it's
natural.
there.
Yeah,
Yeah, you have to know why it's there and what it's actually doing to help you.
yeah.
Not just because you've seen a load of YouTube clips with people
Mm,
using, I don't know, the alligator or something like that. Okay,
yeah.
you have to understand what is it doing, in what way is it benefiting me, and
Mm,
because if it isn't, well then, it shouldn't be. It shouldn't be taking up. It shouldn't be
mm.
taking up the real estate on your chart, should it?
Oh, yeah. And the other last point I wanted to make, I'd written down there just to say it, is that special settings, like, on your various indicators, that's just a river you can go
Yeah,
down. Like, it's a place you
yeah,
can
yeah.
dig a hole for yourself.
That's a proper rabbit hole you can go down if you've got the time and
Absolutely.
inclination
Yeah.
skills.
Go and
For
do it.
but actually, for
The
most
stand,
people, it's
yeah,
yeah,
the standard settings are as good
absolutely,
as anything, I think, for most indicators.
yeah,
I don't change the settings on any indicator because I've except for moving averages, because that's because I have to
yeah,
learn to read it. Not
yeah,
anything. I don't have to. Changing it is going to make it easier to read it. It's just going to change it. And I think an awful lot of people sell books based on changing indicator things, and
yeah.
it's
Because the things
super
that
mag.
makes them
Yeah,
unique, yeah, and it doesn't, yeah, it
no.
doesn't. But no, I'm with you on that. Just keep it simple,
Mm,
all right. Just
mm,
there is no need to overcomplicate this, all right. Just keep it as simple as you can, all right, and focus on your decisions, all right. Focus on the quality of decisions. That reviewing that will take you further than trying to find the perfect setting for a moving average or a stochastic or whatever. Cool. All right. Thank you for that, Ian. Well, our next one is, I'm just looking here. Our next one is all about taking a break from trading because actually, I think I think I'm away next week, etc.
mm.
So we'll return in 2 weeks' time. We'll talk about taking a break from trading, okay, and the benefits, the pros and the cons of it. Listen, as always, if you've listened to the end, thanks very much for sticking with us. As I said, by all means, give us a like. If you've got questions, comments, or topics you'd like us to see us talk about, and there's one or two things that people have sent us, and which we'll build in over the future. By all means, we love hearing from you all and stuff. And yeah, until next time, trade well, everybody, and cheers, Ian.
Bye bye.